As we start Module 3, we're going to ask ourselves an important question. It may be a question you've begun to ask yourself already, which is, should I be trading the market as a whole in an index, or should I be focusing on a specific company? Now, in this session, we're going to break down the differences between those two approaches, the pros, the cons, and when each approach might make the most sense. This ultimately will decide on your goals and a decision you're wanting to make regarding your big picture plan for what you want to achieve through investing in the stock market. Myself personally, I do both. I trade individual stocks and I trade whole indexes using ETFs, and I'll show you the pros and cons of each and when one style and one approach is more appropriate than the other, and then you can make up your own mind. So, which one's right for you? Trade the index as a whole, or the individual stock, or a little bit of both? Let's start with the basics so that none of us are confused. A stock index is a group of stocks combined together, and that represents a portion of the overall market. So for example, the S&P 500 includes 500 of the largest companies in the US. The NASDAQ 100, that focuses on tech-heavy growth names. The Dow Jones includes 30 large industrials. So the stock index, the S&P 500, the Dow, the NASDAQ, it represents large groups of companies that are collected together in an index. You can trade these indices like a stock using ETFs. Remember, the SPY is the ETF for the S&P 500. The QQQ is the ETF for the NASDAQ. Now, how does that compare to an individual stock? Well, an individual stock is just that, isn't it? It's a single company like Apple, Tesla, or Amazon. When you trade a stock, you're focusing on just one business and that one business performance. So straight away, you can see the key difference. The indices reflect the broader market. Individual stocks reflect one company. Now let's compare the pros and cons of each. So first of all, the advantages of trading a stock index. First off, they offer built-in diversification. With one position, you're getting exposure to hundreds of companies. Also, they tend to have fewer shocks, right? Because one company's bad news is diluted out amongst all the others. And they are great for following macroeconomic themes, like what's happening with interest rates? Are they expected to rise? How about inflation? Is it going up or is it going down? All of a sudden, you can have a nice way of expressing a big macroeconomic theme through a major index. Now, what is the cons to a stock index? What's the downside? Well, the downside is they tend to move more slowly than high-flying individual company names. And because they average out performance, so for the S&P 500, it's averaging out those 500 companies, they're also a lot less sensitive to single stock news or really good earnings. It's going to have less of an impact on the broader index if one company surprises to the upside, and so you won't benefit from it as much as you ought. Now, let's look at some pros and cons of trading individual stocks. So the first thing to note is they can offer higher potential rewards, especially when news, earnings, or product launches hit. You can do focused analysis. It's one balance sheet you're looking at, one chart, one catalyst. It allows you to focus a lot more, and some traders can develop an edge by just studying a handful of names deeply. They might, look at just, 10, 12 stocks that they've really studied closely, and that forms a very tight portfolio. But the cons is this: they come with higher risk, especially around earnings or unexpected news. One bad headline and the stock can gap down 10% or more overnight. A bad earnings report, it's not uncommon to see gaps of 10, 15 or 20%. That's not necessarily very unusual. So be aware that individual stocks do come with higher risk. Also, because it's just one company, you are more vulnerable to event risk. Say all of a sudden there's a new technology that makes a company obsolete. Then if you're just invested in one company, it's very vulnerable not only to upside surprises, but also to downside surprises. So when should you trade each one? Okay. So a good rule of thumb is when you want to follow macro trends, Fed decisions, jobs data, inflation reports, then you would look at an index or a sector ETF, as we've discussed in our previous modules. And that's when you want to go into a broad group of companies, either a sector-specific ETF, healthcare, financials, consumer discretionaries, or the big index as a whole. It's also a good way of gaining exposure to an individual country. Say you're wanting general exposure to the UK. The FTSE 100 could be a great index to consider. Or maybe the small caps fits the FTSE 250. If you wanted exposure to the US economy, the S&P 500 would be a great choice. Or maybe the Russell 2000 if you want to focus more on the domestic nature of the US. How about the China 50 if you're looking to get exposure to upside in Asia? Or perhaps the Nifty 50 if you want to look at growth in India. The German DAX, the French 40, the CAC 40, you see the options that you have. So an index can be good when you want to just follow that broad macro trend. It can also be good when you want to just have broad exposure. Say, for instance, you're thinking, I want to have broad exposure to the Japanese market, so I'm going to invest in the Nikkei. Now, you trade individual stocks when you've got conviction about a company's earnings or catalyst. That would be a good opportunity to trade an individual stock. You've studied a particular company and you think their upside has been underpriced by the market. Or you could trade a technical breakout, or there's a high conviction pattern. Maybe you've been seeing a 1 year, 2 year downtrend in line with worse sort of broad market conditions, and then there's a nice head and shoulders pattern that's forming at the bottom. Great. That could be a fantastic opportunity to take a technical breakout on a high conviction pattern. And maybe that will be a good opportunity to invest in one company. Or maybe when you're seeking bigger rewards in a more focused setup, that will be another time when you could look at individual stocks. Many traders actually combine both, using indices for momentum, hedging for broader long-term position, and stocks for more targeted, time-sensitive opportunities. The key here is to align the instrument with your strategy. So, to summarize what we've been looking at, indices tend to give you stability and macro exposure. Stocks give you focus and more potential upside, not guaranteed, and more potential downside. But once you understand when to use each one, you're going to have far more control over your trading outcomes. And as I said at the start of this lesson, I combine both in my trading, and the key to doing that is understanding which approach is suitable for which occasion. Now in this lesson, we're going to look at the most important stock indices from around the world. Now, these indices are more than just, a list of companies. Think of them as kind of economic barometers and vital tools for understanding what's happening in the world's major markets. So remember, when you're looking at the financial world, there is one index which is the most important, and that is the US S&P 500 is arguably the most important index in the world, and it's certainly one of the big three indices. And the state and health of the US economy filters through to the rest of the world. Remember that old saying there is that when America catches a cold, the rest of the world sneezes. In other words, the health of the US economy is so crucial for the global financial landscape that a struggling US economy filters through to the rest of the world. And you'll see that. And in my role as a professional analyst, you see it on a day-to-day basis, that the day-to-day hopes, aspirations, sentiment-driven moves that are felt in the US reverberate on an intraday basis around the world. And the attitude towards the health of the US economy becomes an extended attitude to how investors are feeling across the world economy. And of course, because so many global investors are US based, if US investors are feeling confident, that gives them the confidence to invest in other major countries around the world. So when you consider, 50% of the world's entire GDP nearly comes from just US and China, you can quickly understand that the influence of the US, and the US is the world's largest economy, around a quarter of the world's GDP comes from the US alone. Now, China is expected to sort of pushing up towards catching the US, and some economists say that by 2035, China could have exceeded US GDP, but they haven't done yet. But there's obviously a battle between those two countries. So straight away, you can see that the health of the US economy, the relationship between US and China, is very important for setting the economic barometer that the rest of the world sets its financial temperature by. So with that being said, and it was important to say it, let's start with the most widely followed, the three big US indices, and these far and away have the most impact on the global financial landscape. Now, the S&P 500, includes 500 of the largest companies in the US. It's the most representative benchmark for the US economy, and it covers every major sector. The NASDAQ 100, that focuses a lot on technology and growth stocks. And the NASDAQ is very sensitive to interest rate expectations. Because a lot of tech stocks, they borrow heavily, they're focusing on future investment, the interest rate level is very important for their business models, and low interest rates support investment and growth and further development. High interest rates can restrain that. So as a result, the NASDAQ tends to respond more than the S&P 500 to interest rate moves and to interest rate expectations. Of course, you've got the big names in there, haven't you? Apple, Nvidia, Microsoft, and they really sort of dominate the NASDAQ 100. Now, the Dow Jones, or the Dow, just called, it's the 30 large US companies. It's price weighted, it's not market cap weighted, which makes it a little bit less modern in structure, but it's still very heavily followed. And for the sort of smaller index, for sort of mid-size US companies, a lot of investors will look at the Russell 2000, and that's seen as an index that more accurately reflects the health of the domestic US economy, because a lot of those companies are more US based, and they're not so national or international in the way that those big well-known companies that many of us have already heard of and make the S&P 500, the NASDAQ, etc., etc. Next, now let's move on to Europe. Now, in Europe, the most sort of impactful country within Europe is Germany. Germany is known as the powerhouse, the engine of European growth. It's the manufacturer of Europe. And as Germany goes, so the rest of Europe goes. So if you're looking at Europe, you want to look at France and Germany, mainly Germany's economy. So that means German data that is released, monthly. You'll see it on economic calendars, tends to have an outsized impact on German indexes and the euro, and that's because of its strong presence within Europe. The UK, since Brexit, is no longer part of Europe, but the UK is another leading economy, and in the UK, the FTSE 100 tracks the 100 largest companies listed on the London Stock Exchange. That includes some of the big global names out there like Shell, HSBC, a very international bank, Unilever. DAX 40, that covers the 40 top companies in Germany, BMW, Siemens, SAP. It's kind of the benchmark for the Eurozone's largest economy. And you could also look at the Eurostoxx index, which is a more broader European index. And for France, you could look at the CAC 40, which represents 40 large companies in France. But, the world doesn't just stop there. It's not just US and Europe. There's some other major global indices that you should know about. The Japanese Nikkei 225, that's 225 leading companies on the Tokyo Stock Exchange. Think of big names like Toyota, Sony. Canada, for instance, you've got the S&P TSX. That's Canada's main index, and it's got heavy weighting in energy. Remember, there's a lot of oil resource in Canada, materials, banks. Then, of course, you've got the Nifty 50, the 50 major companies across sectors in India, including Reliance Industries, Tata, consultancy services, that sort of thing. South Korea, you've got the Kospi, and that's the primary benchmark for Korean equities. Think of Samsung, Hyundai. China, you've got the CSI 300. That tracks the 300 large cap stocks traded in Shanghai and Shenzhen. Strong indicator of China's onshore market sentiment. So all of these different indices reflect the economic core of its respective country of origin. So straight away, that means there's a potential opportunity there if you want to gain exposure to South Korea, or you're seeing, hang on, I'm expecting China to continue growing over the next 5 years, and you might want exposure in a Chinese index. Or say I'm expecting India to advance significantly over the next 5-10 years, then perhaps I could look to scale in each month into the Nifty 50, because I think over time that's going to be, ascending as India's economy gains more and more confidence and strength. So every index will also have its own structure, and there are some bigger companies that have more influence. So some are market capitalized weighted. We've looked at market cap already, meaning bigger companies have more influence. Some are price weighted, like the Dow. Some, like the NASDAQ 100, they're very sector focused. Yeah, so they're focused on the tech sector. Others, like the S&P 500, are more broad based. And then you can add up into the smaller companies, for your medium-sized companies, all big companies. Russell 2000, think of the FTSE 250 in the UK, representing the more domestic scene in the United Kingdom. FTSE 100, many of those companies are large international companies, and some of the size of some of the reaction to the FTSE 100 depends a lot on what happens with the dollar moves, because if the pound falls, sometimes you'll see the FTSE 100 rise, simply because if the pound falls against the dollar, it means that all those foreign earnings which are in dollars, when they're brought back to the UK, you've suddenly increased your profit. So that's sometimes why you can have funny relationships between these big international companies. You need to get to know their style and what's influencing them. So why do you want to learn these indices? Well, because the global indices help you measure economic health across countries and regions. And this is really essential for diversification, especially when you're building a portfolio. You know, they act as a real-time barometer for trader sentiment, and they're widely used in futures, ETFs, and macro trading strategies. As I will share with you as we go through this course, I'll introduce you more to my day-to-day setup. You'll see my chart setup, how I look at bonds, equity markets, currencies. You know, I'm looking out to see how those global indexes are acting. I'm looking at China's main index. I'm looking at the DAX. I'm looking at the big three US equity markets, which filter through to the rest of the world. Just knowing that puts you on an advantage to many investors and traders. And remember, a lot of these indexes you can access them through ETFs, which trade just like stocks. So in other words, they're accessible, they're easy to trade, and in many instances, there's very low fees associated with them. So, you know, if you hear someone talking about the SPY, the SPY, the QQQ, right? You say, okay, the SPY, that's the ETF for the S&P 500, the QQQ, that's the ETF for the NASDAQ. You know, they're referring to tradable instruments built on these indices. So by learning how these global benchmarks move and why, you're going to unlock a much deeper understanding of both market behavior and global economics. And especially if you're building a portfolio over time, you can position yourself and try to expose yourself to longer term macro trends, which is really important for decent portfolio building, especially say you're expecting a country to steadily increase and improve and move higher over the next sort of 10-15 years. You know, if you've been buying in month by month on an ETF representing that major index, then you're going to have gained from all of that capital appreciation, which was from your research on a global macro trend. And investors are doing that sort of thing all the time. Let's now talk about something that every trader and investor needs to understand, and that's how stock indices reflect broader economic trends. Take a look with me now at the setup that I have every day to look at broad indices to get a sense of how the general economic trends are moving. Now, stock indices, you can see here I've got the S&P 500, that's the 500 leading companies in the US. I've got the NASDAQ, the tech-heavy 100 companies in the US. I've got the DAX, Eurostoxx, China 50, FTSE 100, and all of them tell us something slightly different. Now, stock indices aren't just price charts. They're actually real-time indicators of what investors expect from the economy going forward. You know, when indices are rising, it usually means that investors are optimistic about growth, and when they fall, it's because they're anticipating slowdowns, inflation, or policy tightening. In other words, interest rates rising, which are less advantageous business conditions, so the stock market tends to fall when interest rates are rising. Now, if you look at the top three indexes that we have here, the S&P 500, the Dow, and the NASDAQ. The S&P 500, this reflects 500 of the largest US companies across all sectors. Because it's diversified, it is also heavily weighted to tech, but it often serves as a proxy for the US economy. Some traders prefer to look at the Russell 2000, which shows 2,000 medium-sized companies in the US, and that's seen as a better reflection. You can see here in the shadow candlestick chart, it's seen as a better reflection of the general health of the domestic US economy. The S&P 500 can also serve as a proxy for the global economy. When the S&P 500 is rising, it tends to be optimism around the whole globe, and it starts from the US and filters down throughout all the other countries. The Dow Jones, now this includes 30% blue chip names, industrials, financials, consumer goods. So it does reflect legacy economic strength. Then, of course, we have the NASDAQ 100, very, very tech heavy. So it's very, very sensitive to interest rate moves. It gives insight into investor appetite for risk, innovation, and future earning potentials. If the NASDAQ is surging, investors are often betting on a pro-growth, low inflation environment. But if it's lagging or falling, then it could be signaling high inflation or higher interest rates or a shift to safety on, perhaps worsening business conditions. Now, global indices can also reflect regional health. So if you take a look at the DAX, that's the 30 leading companies out of Germany. It tracks major industrial export heavy firms. Germany is the powerhouse of Europe. When it's rising, it's suggesting that there's strength in Europe's manufacturing and global trade. If it's falling, it can signal global demand weakness or energy-driven inflation risk. You'll quickly notice as well that often the indices tend to rise and fall together. And all the global indices really take their cue from US indices. Remember, the US is the dominant market in the entire world. Between the US and China, their GDP equates to the GDP of all the other countries put together. So don't forget that the US tends to lead global sentiment, but you can also get the idea of what's happening in regions. And there's no better example than the FTSE 100, particularly after a post-Brexit landscape. These UK companies, 100 leading UK companies, include heavyweight companies in energy, mining and financials. It is a useful indicator of how commodities, global demand and also UK economic sentiment is doing, particularly in a post-Brexit landscape. We also have the China 50 index. Now, this tracks top Chinese companies like Alibaba, Tencent and major state banks. It does reflect also domestic policy tone out of China, growth expectations, regulatory risk. So if the China 50 is rallying, it's often on the back of stimulus from the People's Bank of China or reform signals or some pro-business move that's come out of China. If it's falling, investors may be pricing in policy crackdowns or slowing growth. So not only do you have regional strength reflected by the global indices, but also within each index, sectors can tell a story. So if industrials and financials are leading, it can point to strength and business activity and lending. If it's consumer staples leading, if Walmart is leading with the other consumer staples in the sector out of the US, then the market may be rotating into defensiveness, expecting volatility. And when tech is dominating index gains, we're likely on a very risk-on environment driven by optimism and or falling yields, and interest rates expected to remain low or to be cut. So remember that the indices, they really lead the economy. They don't follow it. Remember that all global indices are actually forward discounting. In other words, what they do is they reflect what's expected to happen in 6 to 9 months' time. So the price you see is what's expected to happen in about 6 or 9 months in the future. The stock indices lead the economy by about that amount of time. Let me show you an example. Do you see here where the global financial crisis started? Look, global financial crisis started, the market bottomed here in March 2009, right? But the S&P 500 started rising before the global financial crisis officially ended. In the same way, do you see that the S&P 500 peaked before the global financial crisis starts? You see that? That the global indices tend to lead the economy, not the other way around. Similarly, if you take a look at COVID 2020, you can see in exactly the same way that even when COVID started, the S&P 500 had already peaked just before the crisis started. Now, I remember the beginning of the crisis. It came on very, very suddenly, so the markets didn't have a lot of time to respond. But even in that situation, still the S&P 500 peaked before the crisis started. And similarly, do you see the COVID crisis bottomed and started to rally before it ended? So the market doesn't react to the news, it's anticipating what's next. The market's always thinking, what's happening in the future? So the next time that you see the S&P 500 rising, think to yourself that you're seeing how investors are pricing the future, because indices don't follow the economy, they're forecasting it and anticipating it. And if you learn to read them right, that will give you an absolutely great head start. So let's keep going on our journey. Now, welcome to this lesson on using ETFs to invest in stock indices. In today's session, we're just going to explore how exchange traded funds, commonly known as ETFs, can give you a broad exposure to major stock indices like the S&P 500, the Nasdaq 100 and more. We'll walk through what ETFs are, highlight some of the most popular ones, and also give a more detailed explanation as to why they're one of the easiest and most effective, cost-effective that is, tools for both investors and traders. Whether you're brand new to investing or you're looking to simplify your strategy, this lesson should give you the foundation you need. So, what is an ETF? You might have heard the phrase quite a few times, but you may be unsure as to actually what is it. I have referred to the fact that it trades like a stock. What does that mean? What practical difference will that make to you? In this next section, I'm going to be outlining to you exactly what that means, so you can understand the advantage that you actually get with an ETF and how that really will be something worth looking at and considering as you move forward. So without further ado, let's move on to the next slide. Now, what is an ETF? ETF stands for Exchange Traded Fund. Think of it like a basket of investments that trades on the stock exchange just like one regular stock. Now what that means is you can buy or sell shares of an ETF at any time during normal trading hours. From the opening bell right through to the market close, using any brokerage account, it's very accessible. Now, the price of that ETF changes throughout the day based on the supply and demand, just like it would for any share of a company, like a share for Apple or Tesla. You get different prices offered at different times of the day. And just like stocks, ETFs have a ticker symbol. They have a bid price and an ask price, and real-time price quotes that update continuously. Just like you could for a regular stock, you can place limit orders, you can buy at market, you can put stop loss orders on an ETF in exactly the same way you would with any individual stock. Now, this is very different from mutual funds. Mutual funds trade once per day after the market closes and always settle at that day's closing NAV or net asset value. With an ETF, you get full intraday trading flexibility. So that means you can buy in the morning and sell in the afternoon if you want, or you could buy in the morning and hold for years if that's your plan. So the ETF is incredibly flexible and easy to access, easy to get in and out of the market. Now, this is where the benefit really comes. Instead of being tied to one company, an ETF holds a collection of different assets. Now that collection could include stocks, it could be a collection of bonds, it could be a collection of commodities, or even real estate investment trusts. But today we're going to be focusing on ETFs rather, that track stock indices. So when you buy one share of an ETF like the SPY, the SPY, you're not just investing in one company, you're investing in tiny pieces of 500 different companies, and that is powerful because it gives you instant diversification in a single simple trade. You can buy the SPY and straight away you've got a diversified exposure to the world's largest market, the US market. Now, let's look at some of the most well-known index tracking ETFs. Now, these are the ones that investors around the world rely on to get quick, broad exposure to the stock market. We've already mentioned the SPY. That tracks the S&P 500. This means it mirrors the performance of the 500 largest publicly traded companies in the US. So when the S&P 500 goes up, the SPY goes up. When the S&P 500 goes down, the SPY goes down. The SPY tracks the S&P 500. Similarly, if you want to invest in a tech-heavy exposure, you would use the NASDAQ. Now, the NASDAQ has a very tech-heavy exposure, dominated by huge tech companies like Microsoft, Amazon, Nvidia, Meta, and it's ideal for investors who want to lean into innovation and growth. So if you believe in the future of technology, then the QQQ ETF gives you that targeted exposure. Then there's another ETF called the VTI ETF. That's short for the Vanguard's Total Stock Market ETF. Unlike the SPY or the QQQ, the VTI doesn't focus on just large cap or tech stocks. It covers the entire US stock market. That includes large, medium, small cap companies. So you're getting a truly broad representation of the American economy in just one simple trade. How good is that? Now, if you're looking for international exposure, there are other ETFs like the VEA, which tracks developed markets outside the US. Think Europe, Japan, and Australia. And there's VWO, which focuses on emerging markets like Brazil, India, China, and South Africa. There really is a wide range of ETFs that you can get access to. And when you're choosing an ETF, you want one that's from a reputable company that has large holdings and that is widely traded. Many ETFs make it very easy to invest globally without having to pick out individual foreign stocks. And this can be great if you're looking for a broad exposure to a particular country. Now, why use ETFs to trade indices? Why use them at all? Okay, so some of the benefits. Firstly, diversification. With a single purchase, you're spreading your money across dozens, sometimes hundreds of companies. Instead of you having to buy a little portion of all these different companies, you might think, well, I want to buy one portion of an ETF that represents many companies. That diversification helps reduce risk. If one company underperforms, maybe another company overperformed. Your entire investment sheet doesn't suffer as much. Now, secondly, this is important, cost efficiency. Right? Don't underestimate the costs to trading. Now, ETFs usually have very low fees, especially compared to traditional mutual funds. That is one of their most appealing attributes, particularly if you are trading your own portfolio or an investment that's tax efficient, something you're looking for your retirement. There's no active fund manager taking a big cut for you, right? Most index ETFs, they're passively managed, which means they simply follow the index. They're not trying to beat it. There's no other management fees to pay. So they tend to be very cost effective and have low fees to get access. They still have some fees, but they're lower than an active actively managed fund. And that's one of the most appealing things about an ETF. Thirdly, they're highly liquid. In other words, they're easy to trade. You can just buy and sell them like any stock with relatively tight bid-ask spreads. It's very accessible. You don't need to wait for the market to close either, like you would with some mutual funds. Some mutual funds you have to, it's end of day price only. Fourthly, flexibility. ETFs work well for long-term investors and they work well for short-term traders. You can hold them in a retirement account for decades, or you can swing trade them over a few days or weeks. Some investors even use them for intraday trading, especially the more liquid names like the SPY and the QQQ. Now, why use an ETF like the S&P 500 rather than using a futures contract to trade the S&P 500? Now, some of you might be wondering this, and some of you might look around and see, okay, I've seen these future prop firms and they're offering to trade the E-mini, the ES, which is the futures representation for the S&P 500. It's called the ES, or the E-mini for short. That's one of its terms. Why don't I trade the E-mini or the ES instead of trading the SPY, right? There's some big differences between these two instruments. Now, at first glance, you think, oh, these are very similar. This is the same, right? No, they are very different. And there's a number of I trade the E-mini and I've bought index ETFs, and they are such different investments. They're like chalk and cheese. Now, futures contracts, they are powerful, but they come with a very steep learning curve. You need to have higher capital requirements and more leverage, which means more risk. And if you're not used to trading with leverage, you will almost certainly lose all your capital very quickly. So future contracts are for advanced and sophisticated traders who have significant experience. They become complex because you need to roll over contracts a certain number of times per year. You have to deal with a lot of leverage, and they're designed for short-term speculative trading. People who intraday trade, they're in and out of the market. Sometimes if you're scalping the E-mini, your whole trade may be just 2, 3, 4 minutes long. So for most retail investors, futures are just simply too complex, especially if you're just starting out. ETFs, on the other hand, like the SPY or the QQQ, are simple to understand, and they're easy to trade. And crucially, they don't expire like future contracts do. You can buy it and forget about it. You can buy them in any standard brokerage account. You don't need a special approval. You're not going to get a margin call as long as you're not using, high leverage. You don't need to roll positions forward every few months. So for long-term investing or beginner-friendly trading, ETFs are the more accessible choice. So to wrap it up, ETFs are one of the most powerful tools for gaining broad market exposure. They offer simplicity, liquidity, diversification, and cost efficiency all in one package. Whether you want to invest in the top 500 US companies with the SPY, or whether you want to ride the tech wave with QQQ, or own the entire US stock market with VTI, there's an ETF for that. And if you want to go global, you've got other ETFs you could look at too. Now, I've given a PDF with this lesson which outlines some of the global indices that you can trade via ETFs. Have a look at that. This is a duplicate of another list of ETFs I've already given you, but it's so important, I don't want you to miss it. So I want to make sure you've got this list of global ETFs, so then you can build a balanced portfolio using different types of ETFs, and you can take advantage of the access that exchange traded funds now give everyday investors like you and like me. What's the difference between index futures and ETFs, or exchange traded funds. Now, both the index futures market and ETFs track major indices like the S&P 500 or the Nasdaq, but how they work and when to use them is very, very different. So let's just refresh ourselves from the previous lesson. What is an ETF? An ETF, or exchange traded fund, are funds that track a stock index and trade like shares. For example, if you look at this is the SPY ETF, and this tracks the S&P 500 index. So this is the S&P 500 index. So if you want to buy into that S&P 500 index, you will use an exchange traded fund, the SPI, and then you're buying a tiny piece of all the 500 companies in that index. And ETFs, exchange traded funds, they're perfect for long-term investing. They're simple. You can buy and sell them just like stocks. They're highly liquid. In other words, it's very easy to get your orders filled. The dividend income can be good with some of the ETFs paying a dividend income. There's no expiry. You can buy it today and hold it indefinitely. So ETFs, they're just ideal for people who want to grow wealth over time or build a portfolio. By contrast, what are index futures? Now, index futures, in a very similar way, say you want to buy the S&P 500, by buying the index futures, you're doing exactly the same thing, but you're buying into the S&P 500 index in a different way. So that was the SPY, the ETF chart. Now this is a futures chart. Now, when you're trading the futures contracts let you buy or sell at a set price in the future. For example, you could look at the E-mini. This is the S&P 500 futures market that I'm showing you here. And I teach traders how to trade that. It's very involved and very skilled. Now, you could also learn how to trade the Nasdaq futures, the NQ. But when you're trading the futures market, you don't own any actual stocks. Also, the positions are highly leveraged. You control large value with a much smaller deposit. And you can see here, here's a trade that I took today. And you can see that from just 6,250 to 6,475, so just 2.25 points in the S&P 500 was $112 just for that tiny amount of points. And 5 points is $250. So you know how many points there are in the S&P 500. So it's huge moves. It's highly leveraged and it's traded nearly 24 hours a day, Sunday to Friday. And the futures market is just designed for short-term traders, hedgers, speculators. But here's the difficulty. They expire every quarter. So you have to roll over contracts if you want to stay in the trade. So that means it's a very sophisticated market. And if you're thinking, well, how do I invest long-term into the S&P 500? For the vast majority of people, index futures will not be appropriate, and the SPY, the exchange traded fund, would be appropriate. So which one's right for you? So if you want simple, long-term exposure to major indices, then you want to use exchange traded funds like the SPY, that tracks the S&P 500, or the QQQ, that's an exchange traded fund that tracks the Nasdaq. If you want fast leveraged access and you have to understand the risk, then you would use index futures. So futures or ETFs? If you're a long-term investor, ETFs are your friend. If you're a short-term trader, futures might be your edge. Just make sure you manage your risk and you're fully aware of the instrument that you're trading. Either way, understanding the difference helps you trade smarter. So let's now move on to our next lesson. Now, you've probably heard the phrase time in the market beats timing the market. Now, this is one of the most important truths in long-term investing. And today we're going to break that down, so what it really means, so you really understand that saying using some real-world examples from the S&P 500, a leading US index, Germany's leading index, the DAX, and the India 50 index as well. So you can see the impact this has in an emerging market and developing market like India. So what's the difference? Well, timing the market means when you're trying to predict the best times to buy low and sell high, you're trying to outsmart the market, you're trying to get the timing just right. The problem is, and take it from a professional analyst whose job is to analyze and try to predict exactly what the market's going to be doing quarter by quarter, it's very hard to do proficiently and consistently, even for seasoned professionals who spend their full time looking at the market. So time in the market means staying invested through the ups and the downs and letting compounding do the heavy lifting. And this is why it's so difficult to time the market. It's because if you miss just a few days of the market's best days, they can destroy your overall return. And the irony is, sometimes the best returns come in the most unlikely of circumstances. Right. For example, you could have missed just 10 days, and if you missed the best 10 days over the last 20 years, it could have nearly cut your overall return in half by just missing the 10 best days over the last 20 years. And you don't always know when those best days are going to come. And the twist is, often the strongest bull markets come in a bear market. Let me just show you an example here in COVID. Now, this is COVID 2020, okay? Now, we've obviously had that huge drop, but look at these bounces we had here. This is just 5 trading days. You can see there, that return is around 12%. So you've had some of the strongest recoveries, right, after the deepest dips. So buying these deep dips over time can represent extremely sensible and good value. Now, if you look at the S&P 500, since the 1980s, the average annual return has been around sort of 10%-ish. So investors who stayed the course, even through crashes, like the 2008 global financial crisis, and COVID, see, dip, recovered. Those who've stayed the course, held, they've been able to generate serious wealth. The thing is, the key is not perfect timing, it's patience. And some of the smartest investors put more cash into these dips. Okay, those who have the spare income can inject more into the market as it dips, seeing longer term value. Let's also now look at Germany's DAX. Okay, Germany's DAX. This includes big companies like Siemens and SAP. This too has rewarded long-term investors. Look at the way it's just moved up from 2004, moving all the way up. Huge returns. And this has been despite Eurozone recessions, despite COVID, despite energy shocks, despite the Russia-Ukraine crisis. Look, the DAX has moved and recovered strongly over time. Let's take an emerging market like India. Here's an Indian ETF, right? You can see that this is in just the last, we're here, 2025. So going all the way back to 2010. So the last 15 years, the ETF has doubled, tripled, depending on where your price has bought in, and that has been despite volatility, despite geopolitical risk, despite inflation scares, despite global uncertainty. You see, it's very, very difficult to predict the best entry point or the best exit point. And sometimes if you just miss some of the best days in the market, you've missed out on those great returns, and you can't always tell when they're going to come. They come in unexpected times. So while market timing can feel tempting, okay, think, oh, I'd really like to try to do this. I just want to get on top of the macro story. I can outsmart the market. It's very hard to do. Discipline does beat prediction. And if you look at the power of compounding here in the S&P 500, you can see if you started with $10,000 and you got a 10% return on that $10,000, and then the starting value for the next year is $11,000, and you got a 10% return on that, do you see how the end value quickly compounds? So whether you're investing in the S&P 500, or whether you're investing in the DAX, or the India 50, or some other market that is local to you, or that you have a particular interest in, the principle is still the same. Stay invested, diversify wisely, and let time work for you. Because remember, in the end, it's not about trying to catch every peak. Instead, it's about not missing the journey. And the longer you allow that process to work, and the earlier you start, the better it should be. Welcome to this very important lesson. If you take to heart this lesson, it will help you stop making a mistake that has destroyed the portfolios and accounts of many beginner traders and some more experienced traders. And this is knowing the difference between dollar cost averaging and doubling down on a losing position. I'm going to explain the difference to you so that you understand it for both. And I'm going to show you why dollar cost averaging is an excellent strategy for buying passive indexes, using passive ETFs over time in world indices. It can be a really effective strategy, but it can be a terrible way of doubling down on a losing trade. And knowing the difference between the two can sometimes be a fine line, but there is a definitive line which I'm going to explain to you in this lesson. Now, first of all, what is dollar cost averaging? Let's just start with the basics. Dollar cost averaging, or DCA for short, it's a long-term investing strategy where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. Now that could mean investing $500 every month into a stock index fund, a retirement account, or even a crypto portfolio. The key here is consistency. You keep investing the same amount whether the market is rising, falling, or just moving sideways. And now here's where the real benefit comes in. When prices are low, your fixed amount buys more shares, right? When prices are high, that same amount buys fewer shares. So over time, this helps you avoid the trap of trying to time the market perfectly. That's something that even professional investors struggle to do consistently. Also, it tends to smooth out your entry price because you're spreading your purchases out over weeks, months, or even years. Now that's why dollar cost averaging is so commonly used in retirement accounts and passive investing strategies. It removes emotion, adds discipline, and keeps you invested, even when markets feel uncertain. So that's the positives to be aware of. It is a tremendous benefit when you're using dollar cost averaging correctly, right? Look, you can add a fixed amount at regular intervals. You buy more when the prices are low, fewer when prices are big, and it's a very common, retirement account passive investing. So it is excellent, right? And if your time horizon is 5 years or more, it can really shine. So it's perfect as well if you want to build exposure gradually, maybe into an index fund or even into a volatile asset class like crypto or emerging markets. And it just helps you, you can invest without the stress of trying to pick that perfect entry point. And you're not trying to time the bottom, you're just committing to the process. You buy consistently over time. It works particularly well in short-term volatile markets, but it has a positive long-term impact. For example, the S&P 500, right, is seeing plenty of pullbacks, corrections, even recessions, but over the long run, it's just trended higher. By using dollar cost averaging, those dips are advantages for you to buy more stock for your investment. And by using dollar cost averaging, you're buying through that noise and letting your time in the market be timing the market, as the old saying goes. And the beauty is you're doing it without needing to react emotionally, because you don't have to react to every news, headline or market fluctuation, because you are committed to the process of buying into that index over time. Right, that's the positive side of dollar cost averaging. Now, of course, it's not foolproof, and dollar cost averaging can be risky when you're using it in the wrong way. Now, this is where the mistake happens. A common mistake traders make is confusing dollar cost averaging with averaging down on a losing position. So this is how it goes, right? They buy a stock. I think that's a good stock, I want to be involved. It falls. They think, oh, good, I'll buy even more, right? Then it falls again and they buy even more, but they buy at a greater quantity over and over. Now, if you didn't intend to do that from the outset of the trade, this isn't disciplined investing. It's actually hope-based scaling, and it's dangerous. And the reason it's dangerous because you're increasing your exposure to a position that's already going against you, and you haven't got a clear exit plan, you see. And if you don't have a stop loss, you could potentially face a very large drawdown or worse, total portfolio damage. Now, in strongly trending markets, especially bear markets, averaging down often leads to a terrible average entry. You're just throwing good money after bad, and the worst part is you're no longer making rational decisions. You're acting emotionally, and you're trying to fix a mistake by doubling down on that mistake, right? So here is the key distinction, right? Dollar cost averaging is a structured, long-term strategy used to build exposure over time. But averaging down is often an emotional reaction to a losing trade. So the first one, dollar cost averaging, is part of a plan. The second one, averaging down, is usually because of a lack of a plan. So just know this, that dollar cost averaging can be a powerful strategy for long-term investors. Adds structure, adds discipline, and helps you stay invested through market noise and volatility. Great. But like any strategy, it has to be used intentionally. It also works best when you have a long time horizon. You're building exposure gradually and you're investing in assets with a strong long-term trend. It becomes risky when it's used reactively to average down onto losing trades without a clear exit strategy. So if you're going to use dollar cost averaging, use it with conviction, discipline, and a plan. That's how you stay in control. And let time and compounding do the heavy lifting for you. Thank you for watching. This is a very important lesson and one that I would highly recommend you take to heart and make sure you understand the whole principle of this lesson. Now, in this section, we're going to explore a very important topic, and that is when to stay out of financial markets. Now, the answer to this question very much depends on your time frame as an investor. So the answer is different depending on your investing time horizon. So we're going to look at when to stay out of the market for the long-term macro investor And then we're going to look when to stay out of the market for the short-term technical trader, because those answers are different, and it's all to do with your investing horizon rather than a definite right or wrong answer. It depends on your actual aims. So let's first of all look at the times when it's right to stay out of the market if you're a long-term macro investor. Now, the thing about long-term macro investing is your edge isn't found in the noise of daily moves. It's in capturing that long-term trend and compounding over time, as we've seen in previous lessons in this module. But this is the tricky bit. When volatility spikes, there's talk of a recession, there's a new financial worry. The financial media thrives on worry, anxiety, fear, and macro traders can be tempted to think, oh, I'll just wait it out. I won't get into this position. I'll hold fire. Now, let's talk about why trying to time the markets, even with good intentions, can really backfire. Because there is a hidden cost of sitting it out. Now, timing sounds very smart in theory, but missing just 10 of the best days over the last 20 years can radically cut your return in the S&P 500, for instance. You know, if you just miss 10 of those best days, you can massively impact your overall return. And remember that the best days, and this is something you need to be aware of, often come after the very worst days, when it's emotionally hardest to stay in. You can see here in the global financial crisis, it hadn't ended, but yet the market had bottomed. So it'd be very hard. You're thinking, oh, this is, you know, imagine all the negative headlines, all the negative news. I must exit my long-term positions, and then only to see them recover within a couple of years. So if your time investing horizon is 15, 20, 25 years, then you need to see these dips in a totally different way. These aren't times during recessions to get out of the market. Actually, what were these opportunities? These were great dip buying opportunities to get into the market at a better price. So you see, if you're trading those big macro themes over 10, 15, 20 years, you know, inflation, monetary policy, global growth, you can't afford to miss the rebounds before the headlines improve. You know, this is still in the height, right, of the COVID-19 crisis, and the market's bottomed. Remember, the market's always looking into the future. It's seeing the end of the COVID recession, right, all the way back in March 2020, right, and the COVID recession officially ended here. So you've got this strong recovery with some of the best days being recorded after some of the very worst days. So you see, smart investors are using these dips to buy in to these better, cheaper prices. So the thing to be aware of is, if you're a long-term macro investor, actually, you know, and what some canny traders do is they will put money into cash. They won't invest it into the stock market until they see these sharp pullbacks, and that's when they invest significantly into these big dips. So you're literally buying when everyone else is selling. Now, with that being said, we can see, yeah, it is better approach for the long-term investor to stay invested through the cycle and actually to rebalance based on strategy. So maybe have a strategy to add in to the market in those worst periods, and then let compounding and recovery work in your favor. It's a really good strategy, and has worked very well over many different markets for many different years. Now, of course, there's a risk. There's always risks. And the worst risk would be, say, for example, in the US economy, say the US economy suddenly was hit in such a devastating way, it was no longer the world's leading economy, then you would see capital outflows that would structurally change the S&P 500, the Nasdaq and the Dow. So there's always risk. There's never a risk-free investment that you can ever make. And we'll come on to this later in the module. There's a specific term called speculator's guilt, which I'll explain to you. But it's this belief that you think, I've got a surefire investment, it can't fail, and nothing can go wrong. Remember, all investments involve risk. Obviously, some risks are greater than others, but all investments do actually involve risk. Okay, so we've seen when not to time the market, and generally for those long-term macro investors, you don't want to be entering and exiting on every headline. And the problem is that this part here, you can often chase re-entry after prices have risen. So you think, okay, and this is the reality of what will often happen. Someone maybe's bought into the market here for a long-term investment, say at 3,239, and then all of a sudden COVID hits, they see their investment rapidly go down, they think, oh no, I shouldn't have done that. I've lost all this money, so I'll take in the loss down here, 2,400, because I think, things are only going to get worse. You read all the headlines, it's the end of the world. You close your position and you take that significant loss. So let's say you were there 3,239, roughly from there, just hypothetically say you bought there, and you sold down here 2,400, right, when you thought so you've lost 27% on your investment, right? Then when things recover, you go back up to here and say, oh, okay, things are recovered, I'll buy back in, right? But you locked in a 27% loss, and then you're starting from here 27% down. Do you see? And all you've done, you've gone back to where you started, and you've got a 27% realized loss, and so you've got much less capital to use up here. That is what it means. You're chasing re-entry after prices have risen. It would have been much better. Imagine instead, okay, you bought in here 3,239, and then you thought, oh, this is terrible, and then you bought a large position. You bought more cash position down here at the 2,400, and then by the time it gets up there, oh look, you've raised, you've moved up 40%. Do you see how different that would be? So if you're the long-term macro investing, keep this in mind, okay? You've got to stay focused on multi-quarter, even multi-year positioning, not intra-week headlines. So unless your system that you're using gives you a really clear exit signal, your best move is to hold through the noise and let the time and trend do it work. That is the case for the vast majority of people. Right? Now, with that all being said, there is a part 2 of this. Remember, and this is for short-term traders. And for short-term traders, there is a time to stay out. Now, this is for traders who are trying to trade for swing trade positions. Maybe they're looking at holding positions for, 3 days up to 2 weeks. Now, there are times when the swing trader does want to stay out of the market because short-term volatility can offer opportunity, but also some environments are really just too dangerous to justify a setup. And there's quite a few of these events. So let's look at some of them here. So first of all, scheduled economic events. Let me just give you a special word here. Now, a mistake that you can go to calendar events and you'll find them over at Forex Factory. A mistake that often people will make is they will think, oh, I'll look at the red high importance data events and they're the ones that matter. It's not as simple as that. Different data points matter at different times depending on what the central bank is focusing on. This is easier to find out than you might think. So say for instance, during the last few years of of 2024, 2023, 2025, a big focus has been inflation data, right? So you know that inflation data is going to be more volatile because the market's focusing on it, because central banks are focusing on it, because they're wanting to bring inflation down. So if a central bank sees inflation falling in this 2023, 2024 environment, then they're going to feel relief, and that makes it easier for them to cut interest rates, right? So inflation suddenly becomes really important. But in the sort of 2010, 11, 12, 13 environment, inflation was just low, depressed. Pre-COVID inflation, there was deflationary forces around the world, and so inflation readings weren't very important and weren't very volatile. So the general rule of thumb is that growth, GDP prints, inflation, economic data points can really impact markets, particularly out of the US and particularly US markets. But certain events have more or less focus at different times. So sometimes the jobs market will be on a lot of focus, particularly if a central bank is saying they're concerned about the labour market. If the Federal Reserve, the US central bank, is saying we're worried about the labour market, then all of a sudden that becomes a really volatile event. Okay, I just wanted you to realise that there are some general principles about important economic events, but specifically the central bank will tell you what they're focusing on. So let's just go back here to the generals. So generally, NFP, that's the US Labour Report, first Friday of every month, very important. It gives you a very early indication of how the US economy is doing. CPI, inflation reports, the Federal Reserve interest rate decision has a huge impact on financial markets. So for instance, if you were a short-term swing trader and the Federal Reserve is meeting on Wednesday, you wouldn't open up a new position on Tuesday, because the chance of the Federal Reserve surprising markets is obviously high just before the decision. And if they gave the market a totally different direction or showed something that they were concerned about, then that would completely invalidate your trade setup, or your trade setup moves rapidly higher or rapidly lower. And either way, it's out of control. It's volatile. It's out of your control. It's not a stable environment where you're relying on a technical setup. It's a highly volatile macro environment that's far better to stay out. GDP releases, unemployment claims, interest rate announcements, all of these kinds of events, it impact the market. They're high risk, they're low control, and they often create massive whipsaws. You can get huge slippage on stops. So your stops may not be honoured because your broker is not able to fill you at the price you want. And you also get false breakouts that invalidate decent technical setup. So even if you're right in the direction, you can still be wrong on the timing. So be aware of that. So if volatility is news driven and liquidity is thin, it's often way smarter to avoid to sit out. Just avoid trading that noise. Other things, earnings reports for equity markets. If you're trading a single stock and you know that an earning report is coming up, the overnight gaps can be huge. Okay, so see NVIDIA earnings around the earnings time. Do you see how volatile those markets can be? Look at those maximum rises, 30, 40, 11%, maximum drops, 22%. Right, same with Microsoft around their earnings period. Look at this, maximum rise, 17, 13, 19, 18, maximum falls, 7, 8. So if you look on the chart, you can see here, look, here's a Microsoft earnings. So look at this. You've got a move here with an earnings report, and they usually Microsoft come after the close. So you wouldn't think I'm going to open a swing trade short here at 393, 2 days before Microsoft earnings, and then you come back to, oh my goodness, I have my stop here at 396, but look, price has gapped up to 422. Do you see? So if you're short-term technical trading, which is absolutely fine, swing trading, there's no problem with doing that at all. And it's a very legitimate way of trading. But the risk is, as you can see from this example, that when you have earnings and that if you weren't aware of them, you can be completely wrong-footed. You can find out the earnings, go to earnings calendars, earnings whispers. They have all the earnings there. You can see here, look, Adobe, you've got the earnings coming up after the close. Okay, be very careful in the few days running up to the Adobe earnings. That would be something to be aware of. And then, before the open, and then you go to the next days, and it tells you whether it's before the open or after the close. So that's the US Open is 2:30 p.m. UK time. That's 9:30 Eastern time. And after the close is obviously when the markets close for the day, which is about sort of 4:35. So really about 9 o'clock UK time is when the close is for the US stock market. So that should give you cause for concern. If you've got an earnings report coming up, you wouldn't want to trade a single equity. Also, macro political events. If you've got a big US election coming up, if there's a lot of geopolitical risk going on, referendums, then stay out those individual stocks. There's also commodity-specific releases. If you're trading oil and there's a big OPEC meeting coming, then obviously you would want to be aware of that. EIA oil inventories, that data is released each week on a Wednesday. So any oil trading that's been done on a short-term technical basis, you have to be aware of that oil inventory report. The private data comes out Tuesday, the night before, and the official data from the EIA comes out on Wednesday. Obviously, USDA crop reports, they can really impact the market too. So just to have to know your market. Quadruple riching days can have an impact, particularly in the futures market, the S&P 500, when you've got lots of options expiring, and any unscheduled news or unexpected interventions can also be a flash risk trigger. So there are a number of things you have to be aware of, and intraday professional traders. This is, you need to be aware. Intraday professional traders, they'll use like a news squawk. So I use a professional news squawk which has someone literally speaking out any high impact events during the day. So, there's 2024, 2025 window, Donald Trump tweets this, Donald Trump says he wants, Saudi Arabia to bring oil prices down, and you suddenly see oil prices fall, 20, 30, 40 cents, or, some other headline like that suddenly breaks, and you see this short-term noise. So for short-term traders, that can provide opportunity, but also risk. If you're swing trading, I have pointed out the main events for you to be looking out for. And the key thing is just to be aware of them and where to find them. So, if you're looking at earnings, you can go to Earnings Whispers. If you want to see important calendar events, then look at something like Forex Factory. That's nice and straightforward, and you can easily filter what's coming up in the coming week. You don't need to pay for it as well. It's free. It will tell you the most important events. Remember, don't be confused. Just because it's red, it doesn't necessarily mean it's the most important. Sometimes you can have an amber thing that's important. It just depends what the current focus of the market is on. So, in this week, okay, inflation is still very important. GDP is important for the UK. PPI, and labour market is very important, and also sentiment around consumers in the US. So this particular week, it's you can see at a glance, okay, well, if I was short-term trading some stocks, I'll be very careful of trading them around Wednesday, because I know I've got this CPI print that's going to impact monetary policy expectations and will likely produce some significant volatility. So there you go. When it pays to stay out of the market, the risks of short-term trading, it all depends on your outlook. Long-term macro traders, you're better off just ignoring the noise, and if anything, buying into the bad news. That's the general rule of thumb, especially if you've got an investment horizon of 15, 20, 25 years. If you've got a short-term trading opportunity, then there's a number of events you need to be aware of depending upon the market that you're trading. And of course, remember, you don't always have to choose. You can do both strategies at the same time. You can have one investment. This is for only long-term macro investing, and then this capital that I'm using is for short-term trading. And you approach risk in two different ways depending on what your goals are. Okay, let's go on to the next lesson. So let's now talk about two of the most powerful ways that traders can use stock indices. That is, one, to build directional bias on short-term trading opportunities, and two, in order to hedge risk. So they're the two lessons, very important ones, that we're going to learn during this lesson. Now, whether you're trading stocks, futures, options, or even FX, indices like the S&P 500, the Nasdaq, the Dow, Russell 2000, Euro stocks, FTSE 100, they all give you a visual assessment of whether you're on the right side of the market or not. It lets you know what that macro mood is over the whole world. We're also in this lesson going to look at a free tool to help you, the FinViz heat map, that allows you to visually assess the market breadth in just a few seconds, and I'm going to point that out to you later in the lesson. Now, part one, using indices for directional bias. I'm also going to give you another little tip here, right? Most traders, they don't trade in isolation. They ask, is the broader market supporting my idea? And here's how the indices can provide context. Say the S&P 500, right? You want to trade a US stock and it's trending higher, right? That supports long setups. Similarly, okay, say the NASDAQ, say you're in a scenario where, okay, the NASDAQ, it's trending sharply lower, it's falling hard, and you're long tech stocks, then that's a big red flag. If, on the other hand, indices are choppy or flat, just moving nowhere with no real direction, that can be a red flag, and it might mean that it's more prudent to stay in cash and to not initiate a position. So traders will often monitor the S&P 500, the NASDAQ. Remember, they'll also look at the Russell 2000 because that gives you a sense of how the domestic US economy is doing. And you can see here the yellow candlestick chart, that's the Russell 2000. You can see it's just US 2000 in TradeView. You can look up that ticker. But remember as well, you can also look at ETFs. So if you want to look at the ETF, like the ETF for the Russell 2000 is the IWM, right? If you want to look at the ETF for the S&P 500, it's the SPY. Remember for the NASDAQ, if you want to look at the ETF for the NASDAQ 100, remember that you look at the QQQ, and you can see here, look, to see how the QQQ is just mirroring the moves in the NASDAQ 100 index. So that ETF is a very simple way to trade the NASDAQ 100. You just buy and sell it like an ordinary stock and share. So it's a very simple way of being involved in the index. Similarly, you could look at trading the DAX, the India 50 for global sentiment, and just think, well, is it trending higher? If you want to trade a German stock and the DAX is trending higher, that gives you good confirmation that your move might very well be supported by the broader index. And not only do you want to look at the trend, you also might want to look at the volume. So is price moving higher is volume rising or falling? You can see here, okay, market's falling and the volume is rising. So you're thinking, well, okay, that does make me question whether I want to go long here. Definitely with such a hard fall on rising volume. So remember, and as we've looked at this in other lessons, that volume confirms price. If there's a breakout on low volume, it's less reliable. As you can see here, okay, you've got a breakout here of these highs, but look, it's on high volume. So volume confirms price. So think, is volume supporting the move? Is the trend supporting the move? And that can give you a directional bias. And when the market's moving in your direction, then that gives you that confirmation that you need to take your position, particularly if you're short-term trading. Now, also, let's understand the breadth, right? So to check the breadth of the market, you can look at it visually here at FinViz. Now, look at the overall color. You can see here on this day, look, the overall color is green. So that means more stocks are advancing. Now, this is also weighted in accordance with the market capitalization. So if there's a larger influence in the index, like you can see Microsoft, Apple, and Nvidia have outsized impact on the index as a whole, so they're larger squares. Whereas some of these smaller stocks, yes, they're still part of the S&P 500, but they have a relatively small market capitalization. So if you've got a mostly green map, right, that tells you that it's a strong broad-based rally. If it's a split map, you know, some parts of the map are green, some parts are heavily red, then you've got weak internals. So even if the index is up, be careful, because internally there's something not quite right and the rally is not being supported. So if you have only got, you know, say you've only got tech stocks rising, like Microsoft, Apple, Nvidia, Google, Meta, Amazon, and the rest of the index is red, then the index may be rising just on very narrow leadership. So you want to look, okay, well, if financials and industrials and consumer discretionaries, if they are also green, then you're thinking, okay, that's a strong, broad-based, likely healthier rally. And you can use this drop down to compare the strength of the market over this time frame. You can look at for the last week, because okay, that gives you a different picture. The last month, and you can see, can't you, the clarity on what's moving the market. And remember, it's divided into sectors as well. It's a technology sector, consumer cyclicals, consumer defensive, industrials, and you can see which sector is primarily driving the market. You can see here over the last month, look, it's mainly a technology driven lead. Now, you can also use indices for hedging, right? Now, I'll give you a PDF to show you the way to do this, because let's say you're long the S&P 500, okay? And you're suddenly worried, okay, you've got a long position and you're suddenly worried about an upcoming Fed interest rate decision, or there's a CPI print coming out and you know that if it surprises markets, there's going to be a huge reaction. So there's a couple of ways you can hedge risk. And what you can do is you can use an inverse ETF. So for the S&P 500, an inverse ETF would be something like this, like the SH here, right? And do you see how this inverse ETF, it rises when the S&P 500 falls? So say there's a very short-term risk you want to hedge against. If you buy a short-term ETF that's the inverse of the S&P 500, you can just secure yourself and hedge some of the risk that you're using. So for instance, on the NASDAQ, say you were long the NASDAQ and you want to think, oh my goodness, you know, I'm a bit concerned that, you know, you're long ETF, but then you're concerned, oh, hang on, there may be a big risk event coming up, and I just want to hedge myself against that risk. You could maybe use the PSQ. Right? Now that is the inverse moves for the NASDAQ. You see in the NASDAQ, do you see how the NASDAQ, when the NASDAQ falls, this inverse ETF drops. But likewise, when the NASDAQ is dropping here, see how the NASDAQ's falling, then you have the PSQ ETF rising. So this PSQ is an inverse ETF for the NASDAQ. It can be a very helpful tool. I'll give you an ETF cheat sheet in a PDF that will accompany this lesson so you can see which ETFs are the inverse of which index. So I'll give you for the S&P 500 and for the NASDAQ. And note that you can get different types of inverse leveraged moves. So you can get leveraged once, twice, 3 times leveraged. I'll give you a couple of options, and that just shows you whether you want to have a strong hedge in place or just a relatively weaker hedge in place. A couple of things to be aware of. ETFs are designed for daily use. They're not designed for long-term short. So you wouldn't want to be holding an ETF short for multiple days, because compounding effects can really cause sort of errors with that. So it's best used for very short-term hedging or tactical trades. That's the way to use it. So what do you use indices for? Use indices to gauge directional bias. It allows you to stay aligned with the market tone. Use breadth using tools like FinViz, and that can help you to see whether the move is being supported broadly across the index, or whether the index is split, or whether there's just a few narrow leaders lifting the index. And above all, remember that smart trading isn't just about, setups. It's about the context. And knowing what the market is doing gives you the confidence to trade with conviction and not confusion. And by dialing in to these major indexes, you can see whether your move is likely to be supported by the broader index, or it's likely to be resisted by it. And that can be another helpful tool, because you can say, okay, well, if the broader index is falling, then maybe that setup is more likely to have a false breakout, or to be a unsupported and a failed technical pattern. You can use it in a number of different ways. Okay, folks, let's keep going. Now, in this session, we're going to look at how to blend stability from index investing with the strategic upside of more active opportunities. Now, this is a flexible approach that's used by both institutional and retail investors, and they use it to pursue long-term growth while managing risk. And we call this the core satellite portfolio strategy. So let's dive in. So what exactly is a core satellite portfolio? Well, at the center of your portfolio is the core. You can see that on the right-hand side of the pie chart. Now, this is typically made up of long-term, diversified holdings, typically low-cost index ETFs like the SPY or the VTI. Now, these core positions, they're designed to stay in place through all market conditions. They bring stability, diversification, and importantly, low fees. Now, around that core, you have your satellite positions. You see that in the other segment of the pie chart. Now, these are smaller, more tactical positions meant to capture alpha or outperformance. So these could be sectors you're really bullish on. Thematic ETFs, for instance, focused on innovation. Or it could even be individual stocks that you've researched deeply and you want to focus part of your portfolio on. So by combining these two, the idea is you get the best of both worlds. Stability and growth, right? But discipline and flexibility together. Now, let's look a little bit more closely at the core. Now, the core is the foundation of your portfolio. This is where the bulk of your capital goes, typically 70 to 80% of your total portfolio value. And the goal here is broad market exposure with minimal fees and high diversification. And here are some of the popular ETFs to consider. The VTI gives you the entire US stock market access from large caps to small caps. The SPY tracks the S&P 500, providing exposure to the largest 500 US companies. And VEA covers international developed markets, helping you to diversify beyond the US altogether. And of course, you could consider other ETFs as well for the UK, for the FTSE 100, for the DAX in Germany. You can look at the earlier module on ETFs to find their ticker. But your core, right, is built to weather the storm. It's the part of the portfolio that you just hold. regardless of what the market is doing this month or this quarter, it's stable, it's low maintenance, and ideally, right, it grows steadily over time. Now, that's the core of your portfolio. What about the satellites? Now, these satellites are your strategic growth plays, right? Smaller positions that you add around your core to reflect your market views, your convictions, or maybe current themes. Now, satellite allocations, they're typically around 10 to 30% of your total portfolio. Some examples of what you can include, like sector ETFs like XLK for tech, or XLE for energy. If you see upside in those areas, you're anticipating it, you could invest in some of those ETFs. Or you could look at thematic ETFs targeting ideas like AI, clean energy, or electric vehicles. You could also use funds focused on ESG investing or next generation innovation. You might even hold individual focused stocks or actively managed ETFs. If you have specific high conviction ideas, that's where these go. Remember, satellite areas of your portfolio are higher risk, but they can be higher reward as well. You can adjust them too based on market conditions, the macro trends that you see out there, or your own research. But remember, satellites should be sized appropriately. They're meant to enhance the core. They're not meant to overwhelm the core and dominate the portfolio, because then your risk profile will be out of sync. So, let's summarize. A core satellite portfolio gives you a structure that's both stable and adaptable. You get the confidence of long-term, low-cost investing with the freedom to act on ideas and opportunities without betting the whole portfolio. It's a strategy used by professionals, but it is simple enough for any investor to apply. And the beauty of this is that you can be quite flexible and active in the market while also keeping the stability of those long-term positions. Perhaps you could be using a dollar cost averaging strategy to buy into your core of the portfolio and then keep some funds available for that active management for individual stocks or specific sector ETFs that you can see. I wanted to end this section by drawing your attention to a very important index called the VIX. Now, this can be used as a proxy indicator for how fearful markets are. And particularly, this is useful for fear in the stock market, particularly US equities like the S&P 500, the NASDAQ, the Dow, but also it does show the mood for global equity appetite across the world. So without further ado, let's jump into the screens and I'll show you the index, where to find it, and how to use it. So you can see here's the broad global indexes that I use every day in my trading and analysis. And one index I have at the bottom right is this index called the VIX index. Now this is my go-to quick index if I want to see how fearful markets are. You can see the ticker is just VIX. That's all that you put in, VIX. And without getting into the technicalities, what the VIX shows you, it shows you when S&P 500 stock traders are buying put options in the options market. Now, I don't want to get into what options are with you now because it'll become confusing. But if you don't know what an option is, it's like a financial insurance product. So just like you might buy an insurance product to protect your house from a storm, or you might protect your house from a flood, you would buy insurance. Well, in the financial world, you can buy an option, which is like an insurance product. So when you see the VIX, the volatility index, rising, what that tells you is that S&P 500 traders are buying insurance against a drop in the S&P 500. So you see the way that the VIX spikes, right? It spikes up. Now, normally, it's when it's sort of fairly stable, it's trading around this 14, 15 level at the moment. But look at these times when it spikes higher, spikes higher, spikes higher. Now, when the VIX spikes higher, you will notice that stocks fall. So let me overlay the S&P 500 chart. So the S&P 500 chart here is in the blue line. And what do you see? Look, when volatility is up, the S&P 500 goes down. Why? Because when volatility goes up, that is S&P 500 traders buying insurance against further downside in the S&P. So of course, when volatility is rising, S&P 500 is falling. Also, look, when volatility is falling, you see here, falls, look, the S&P 500 rises. Look here, VIX surges, right? The S&P 500 drops. The VIX drops, the S&P 500 rises. Look here, volatility surges, the S&P 500 drops. Volatility drops, the S&P 500 surges. And you'll see that that relationship is solid all the time. Now, you can use this VIX just as an indicator on its own. And you can just look at it and say, okay, well, what's the VIX doing today? Day by day. So, you know, if you're seeing a day when volatility is rising, it means traders are worried about downside in the S&P 500. So that means if you are trading an intraday setup, say you were looking to get into a short-term swing position in a particular stock and you're looking to go long, if volatility is pushing higher, that may not be the day. You might come back the next day and say, okay, look, volatility is moving. Oh, it's closed back below that level there. Okay, I can reconsider my longs again. And you can just mark the VIX with normal technical analysis. Support, resistance levels, zones, trend lines, and that becomes a very helpful tool for understanding what sentiment is. But you can use it not only for the S&P 500, you can even use it for the NASDAQ. So here's the NASDAQ ETF, the QQQ, and notice, look, when volatility is rising, look, the NASDAQ's falling. When volatility is falling, look, the NASDAQ's rising. This is an intraday move. Okay. Oh, look, volatility surges. The NASDAQ drops. So, if you haven't got this as a tool, it's definitely one that you should consider using and bringing into your trading arsenal. It's called the VIX. It's an insurance product for S&P 500 traders that's being displayed here. When the VIX is going up, it means there's risk of downside coming up in stocks, and that can help you with timing your stock entries. It can also help you to know whether it's an appropriate time to be going long or to be going short. It gives you a quick way of understanding what global sentiment is without having to go through every single index. You can look at the VIX and that gives you a quick proxy as to the global sentiment for stocks on any particular day. And of course, you can use it on a daily chart. You can also use it on the weekly chart. And you can see that when there's certain, when it goes over certain levels like 30, 33, you can see here on the weekly chart, that whenever you get that, when it's above 33, look, stocks moving lower. When it's higher, stocks moving lower. When it's higher, stocks moving lower. So the higher the VIX goes, the more risk is out there. So I hope that helps and you can add the VIX into your trading arsenal. Welcome to this session on using the days to cover ratio as a sentiment indicator. So what I'm going to do now is unpack a tool, and this tool can give you insight into how traders are feeling, especially those betting against a stock, and it's called days to cover. And it's based on a concept known as short interest. Let me explain it. So first of all, what is short selling? Short selling is the act of selling a security that you don't actually own. That sounds strange, right? But here's how it works. You borrow shares from a broker and immediately sell them on the open market. Now you're holding that cash from the sale, but you still owe those shares to the broker. So if the price subsequently drops, you can buy back those same shares but at a lower price, return them to the broker, and then you keep the difference as a profit. But if the price rises, you'll have to buy the shares back at a higher price, and that means you're going to take a loss. that's partly why short selling is considered risky, because your losses are theoretically unlimited because prices just go up and up and up. Now, short interest as sentiment. Now here's where it gets interesting. I'll show you, this will all make sense by the end of this lesson. Don't worry if it's a little bit complicated, but I just want to explain it to you. Some traders will use this short interest as a way to gauge the market sentiment. So if there's a lot of short selling in a stock, it often means investor sentiment is negative. People are betting that the stock will fall. And one of the simplest ways to measure this sentiment is by using what's called the days to cover ratio. So what exactly is days to cover? What it does, it tells us how many trading days it would take for all short sellers to buy back or cover their positions based on the average daily trading volume. The formula is simple. The days to cover equals just the amount of short interest divided by the average daily share volume. So let's say there's 10 million shares sold short and the stock trades 1 million shares per day, then the days to cover ratio would be 10. That means in theory, it would take 10 trading days for all short positions to be closed if everyone started buying at once. It's also helpful to know when this data becomes available. Brokers are required to report short interest twice a month, on the 15th and again at the end of the month. Public reports typically come out 8 business days later. So when you check short interest data, just keep in mind that there is a slight lag. You can find the days to cover information on platforms like the NASDAQ website, which displays the short interest numbers and the days to cover ratio for each stock listed on the exchange. So how do we use this information? It's simple. When the days to cover ratio is low, say 1 or 2 days, it means that short interest is small relative to daily volume. So there's a lot less risk of a short squeeze, and sentiment, might not be very bearish. But when that ratio is high, think 5, 10 or even more, that suggests that a lot of traders are short. And liquidity might be a problem if they all rush to cover. This can be a warning sign if you're considering shorting the same stock. But it can also be used as a very interesting contrarian signal. So let's say a stock has a really high days to cover ratio, 8, 9, 10, something like that. There's lots of short sellers, there's lots of bearish sentiment. It'll often be on some fundamental news. But now imagine that some unexpected good news hits. Strong earnings, a surprise partnership that's going to boost profitability, a regulatory win. Now, what are those short sellers going to do? They'll start to panic because the stock price is going to start to rise. They're forced to buy back shares quickly to limit their losses. And of course, this sudden wave of buying, what does it do? It adds the upward pressure on the price. That's what you call a short squeeze. And the higher the days to cover, the more violent that squeeze can be. So as a contrarian trader, a high days to cover ratio could signal that if there's a bullish reversal and there's a reason for it, it might have extra fuel behind it. Let me go and show you on the NASDAQ website. Here's the NASDAQ website, nasdaqtrader.com, and you can look here, nasdaqtrader.com/trader.aspx ? ID equals short interest. Now, what you can see here is the current short interest. You have the average daily share volume here, and then you have the short interest, and then you have the days to cover, right? So here I'm looking at a stock like Microsoft, and you'll see that quite often Microsoft has a, low days to cover ratio. You can see, look, it's quite low. It could be 1, 2, 3 at the moment. And this is where, your sentiment shifts can quickly happen if you have a high days to cover ratio. Let's look at something like Tesla. And you can see they're quite liquid, right, and quite a high days to cover ratio, low day to cover ratio, so quite stable, right? Amazon. Here you see days, again, quite a low days to cover ratio. See, these big name stocks tend to have a low. Let's try Apple. Right, again, quite low. Whereas some like high short interest might be something like, Beyond Meat, something that's quite a. See, that's got a high data cover ratio. So say if all of a sudden there's some really good news that comes out for Beyond Meat, then that could really send it higher. Let's look at something else like GameStop. That's a big meme stock, isn't it? Let's try something else. Let's try AMC, see if that's around. Beyond Meat was a good example. You saw that days to cover ratio was really, really high, right? Okay, let's give a medium one. Boeing, that's, there's been quite a lot of short selling at the moment for Boeing. It's just been a very sad, another plane crash. Oh, that's not there. Try Uber. Let's try Target. Some of these symbols aren't here. Try one more. Right. Last one, we'll go with another big name stock in the video. There may have been a little glitch in the system. Maybe if I just refresh the web page. There it is, okay. See a low data cover ratio. So the important thing is you can see the difference. So what you're looking for is a high data cover ratio that is suddenly contradicted by good news, good earnings reports, and you know that there's going to be a lot of liquidity to have to be unwound. So you can have a look at that. It can be a good technique and a good strategy, worth having a look to see if there's any interesting opportunities with that days to cover ratio.